Gold and silver are having their worst days probably ever, arguably their best run of a few months right before that. So silver bottoms at, $85 an ounce or whatever on the COMEX after this correction runs its course. And I think the march higher will begin again. I don't think there's any real easy way to outline an eventual high then. What's the highest possible price for silver? We cut the value of the dollar by 2/3 and revalue gold to $15,000 an ounce, something like that. For the past couple of months, the physical markets in Asia have priced silver at a dramatic premium to the paper markets in the US. The real cost of buying silver, if you need physical silver, is much higher than it's been in the US lately. A lot of futures contracts that technically can stand for delivery and demand physical silver will do that, and there won't be any on the exchange to make good on those contracts. The exchanges will have to default. And at that point, silver becomes unobtainium. The least painful choice that we're going to have in front of us pretty soon is going back to the gold standard. Gold and silver are having their worst days probably ever. After arguably their best run of a few months right before that. So these are wild times in precious metals and in commodities in general. Well, I think when historically, when countries ruin their finances and they start debasing their currency in order to manage, the next election cycle or whatever, historically, capital has flown out of those currencies that are being debased and into real assets. Gold and silver are the forms of money that we've used for the past 3,000 years. So they're a big beneficiary of that. People start buying gold and silver. They buy gold first and then they buy silver. And then they also buy other kinds of real things like farmland and timberland, things like that, because governments can't make more of those things out of thin air. So they can create as much new currency as they want to. But they can't make more gold. They can't make more silver. Those things have to be dug out of the ground very laboriously, and there's just not that much of them left. So I think the kind of situation that we've created for ourselves is really good for gold and silver. It's the kind of system or kind of situation where money is going to flow their way. And that's part of what we've seen in the last couple of years. Gold and silver languished for the longest time. And then all of a sudden they started rising. And rising and rising.
The quiet truth here is that currency debasement isn't an accident. It's a political strategy with predictable financial consequences. As John Rubino has warned, every major fiat breakdown in history pushes capital toward assets governments can't print, and gold has held purchasing power through over 3,000 years of resets. Since 2020 alone, global money supply growth exceeded 40% in several developed economies, while mine supply barely moved. That imbalance matters for long-term investors, protecting real wealth. When currencies weaken slowly, people ignore it until price signals force action. And what John Rubino points out next explains why this shift accelerates suddenly, not gradually.
A big part of that is, what I just said, that the rest of the world recognizes that fiat currencies don't have much longer to live. So central banks around the world are buying gold, and they're not price sensitive. So they have a certain number of tons of gold they need to achieve, and so they're just paying whatever they have to pay. And on the silver side, silver is, besides being a monetary metal that is pulled up by gold when gold goes up, silver is also an industrial metal that we're running out of. It's necessary right now for solar panels and electric cars and high-tech military hardware and lots of other things that basically have to be built. If you're Tesla, you're not going to close down your factories because silver got a little more expensive. You're just going to buy as much silver as you need and then, price it into your cars. So the demand for silver has been rising dramatically, and physical silver, because that's what industrial users need, has becoming more and more scarce. So, today is all bets are off. I don't even know what the relationships are out there because silver and gold are having such a dramatic correction.
This is where investor logic diverges from headline pricing, because central banks don't behave like traders. They behave like insurers. John Rubino has highlighted that central banks added over 1,000 tons of gold in recent years. Even as prices rose, signaling urgency rather than speculation. On silver, industrial demand now consumes more than half of annual supply, driven by EVs, solar and defense systems that can't substitute easily. That means price corrections don't reduce demand. They simply transfer costs downstream. For portfolios, this breaks the usual cheap versus expensive framework. And what John Rubino explains next exposes why paper prices may be losing relevance altogether.
But for the past couple of months, the physical markets in Asia have priced silver at a dramatic premium to the paper markets in the US. So the real cost of buying silver, if you need physical silver, is much higher than it's been in the US lately. And that's a sign that physical is starting to take over pricing in that market, and that there's a growing risk of default in the futures contract-driven exchanges like the COMEX, where a lot of futures contracts that technically can stand for delivery and demand physical silver will do that, and there won't be any on the exchange to make good on those contracts, and so the exchanges will have to default. And at that point, silver becomes unobtainium. You can't get it at any price. And the panic buying, well, actually, we've probably seen a little bit of that lately, because
Yes.
the last couple of months in silver have looked like panic buying. So people are just, they're looking for inventory, and they're not worrying about price. And there doesn't really seem to be any end to that process, because solar panel demand is still rising, and there are new batteries coming along in the electric car market that use more silver and sound fantastic.
This is the fracture Wall Street avoids discussing. When physical markets ignore futures pricing, confidence quietly erodes. John Rubino has noted that COMEX registered silver inventories have fallen sharply over the past few years, even as paper contracts multiply. A system built on leverage only works if delivery is optional. Once buyers demand metal, the math collapses. Asian premiums signal that reality is already diverging from US price discovery. For investors, this raises counterparty risk most ETFs never address, and what John Rubino hints at next is why shortages don't unfold calmly. They snap.
I think cars using those batteries are going to be in high demand if they're not crazy expensive when those batteries hit the market. So our demand for silver is going to rise, and the supply of silver is drying out. So you've got this this really interesting period where it's not clear what happens when a lot of big industrial users just have to have X amount of silver, and it doesn't exist, So we'll see. But I think that's still out there coming. So if silver bottoms at, $85 an ounce or whatever on the COMEX after this correction runs its course, then I think the march higher will begin again. And I don't think there's any real easy way to outline an eventual high then. Like what's the highest possible price for silver? I don't know. If industrial use kind of plateaus and companies just replace silver with copper at some point in the intermediate term future, but gold continues to go up, then gold will pull silver up along with it too. So I don't know. I don't know what the high point is for precious metals, but I think it's considerably higher than today's prices.
This is the uncomfortable zone markets struggle to price. Forced demand meeting constrained supply. As John Rubino has emphasized, industrial buyers don't speculate. They secure inputs regardless of price, especially when production lines are at stake. Global silver mine supply has been flat for years while demand projections continue climbing into the late 2020s. That creates asymmetric upside and limited downside once inventories tighten. Investors chasing exact price targets miss the structural setup entirely. And what John Rubino underscores next is why metals rarely peak when fundamentals are still deteriorating.
Well, a lot of countries, the BRICS countries in particular, Brazil, Russia, China, India, and South Africa, they are just done with the U.S. using the dollar as a weapon and pushing them around. So they're setting up a parallel monetary system. And they're buying lots of gold, and they're creating entities that are kind of their versions of the International Monetary Fund, the World Bank, things like that, the SWIFT bank settlement system. So they're kind of setting up a separate monetary system that doesn't really need dollars on the scale that they have in the past. And so a lot of those countries are selling their treasury bonds and using the proceeds to buy gold in most cases. So this, again, we don't know how big this is, but it's potentially a pretty big deal. Because when a country like China that owns a lot of treasury bonds starts selling their treasury bonds and replacing them with gold, that puts upward pressure on U.S. interest rates, which in turn takes us back to the interest cost on our debt. You know, if interest rates go up, that makes the interest cost on our debt go up even more. And so you get the potential for some kind of a death spiral. So that's part of that story.
This isn't de-dollarization rhetoric. It's balance sheet behavior, hiding in plain sight. As John Rubino has pointed out, BRICS central banks aren't making speeches. They're reallocating reserves, and gold buying by non-Western central banks hit multi-decade highs recently. Selling treasuries quietly pressures US yields without a single policy announcement. That raises borrowing costs, widens deficits, and feeds the exact instability policymakers claim to be controlling. Investors need to understand this isn't anti-dollar ideology. It's risk management by governments. What he flags next explains why this shift matters, even if headlines stay calm.
And here again, we don't know exactly what the details of it are going to be. But these guys are taking the steps they need to break free, at least partially, from the dollar-denominated debt system that has ruled the financial world for so long. And if they keep this up, they are also kind of flirting with a gold-backed currency that they'll use for trade among themselves. So, however you look at the U.S. financial system right now, it's kind of beset on all sides. There are big problems that we don't really have any way of dealing with. And so the question isn't, can we fix this? It's more, which kind of a crisis are we going to choose? Are we going to accept a 1930s style deflationary crash, or a Weimar Germany hyperinflation, or something new that hasn't happened yet in history, but we're going to, choose it because there is no real fix for this kind of thing right now. But I think the least painful choice that we're going to have in front of us pretty soon is going back to the gold standard, where we just choose sound money going forward.
This is the moment policymakers avoid describing honestly. The problem isn't solvable without pain. John Rubino has warned that debt to GDP levels above historical norms limit every policy option, making crisis selection inevitable rather than optional. The US faces record deficits while rates remain structurally higher than the post-2008 era. That means either defaults, inflation, or monetary discipline. And none are politically comfortable. For long-term investors, this reframes risk-free assets entirely. What he explains next shows why choosing stability comes at a social cost markets rarely price in.
But in the process, we impoverish all the people who trusted the government and kept government bonds and bank accounts and things like that. Those things become much less valuable when you devalue your currency and go back to a gold standard. But I think, or I hope, let's put it this way, I hope we choose that because that's the only thing that gives us a high likelihood of surviving as a culture going forward, and hyperinflation on the scale of Weimar Germany or a 1930s style depression. You don't know what comes after that. Dictators basically came after that in a lot of parts of the world. So hopefully a gold standard will be the least horrible option that our leaders are looking at a couple of years hence, and they'll choose something like that.
Yeah, but what would that gold standard mean for the average man on the street in the real terms?
Well, it would mean that the dollars that you hold get a lot less valuable. Let's say we cut the value of the dollar by 2/3 and revalue gold to $15,000 an ounce, something like that. So that means you are instantly impoverished if you held a lot of dollars because the price of everything has gone way up relative to your bank account and the cash you have stuffed under your mattress.
This is the part no central banker explains at press conferences. Stability punishes trust. John Rubino has emphasized that monetary resets don't destroy wealth evenly. They wipe out savers first while protecting hard assets. A 2/3 currency devaluation isn't theoretical. It mirrors real historical resets where cash holders were quietly sacrificed. That's why asset allocation matters more than income headlines. For investors, this forces a rethink of safe holdings like bonds and cash-heavy portfolios. What he underscores next is how social consequences follow financial ones.
So those people are hurt very badly. But a gold standard is the kind of system that can go forward in a stable way. In other words, we can have zero inflation going forward. And, as long as we stay with that system, we're a viable financial system in the US and maybe around the world. And so the whole monetary crisis, currency reset thing will be over. We'll have a viable monetary system. And for the people who have a reasonable amount of capital, it'll work really well. It'll protect their capital. Interest rates will be very low. It'll make it easy to finance things. That's the way it was for almost 200 years during the gold standard that the world was on up until 1913. That was the last part of that, at least, was a financial golden age because we had deflation, very low interest rates, and very fast growth. So we could go back to something like that. But we have to get past the civil unrest that comes from impoverishing 2/3 of the population by devaluing the dollar on that scale. So that's bad. It's not nearly as bad as the 1930s style depression, but it would still be tricky to navigate for a couple of years.
This is the long-term trade-off markets struggle to model, short-term chaos for structural stability. John Rubino has noted that extended periods of sound money historically align with low rates, real growth, and capital formation. The pre-Annan 1913 era delivered expansion without perpetual inflation, a data point modern narratives ignore. But the transition cost is severe, especially for over-leveraged households and governments. Investors positioned with real assets fare differently than those anchored to nominal returns. And what he highlights next is why timing, not theory, decides survival in resets.
Are you bullish on, is commodities supercycle alive? And what commodities are you playing right now? Is it uranium, copper? Is it energy metals? How are you playing the commodities?
Yeah, the big risk for the commodity supercycle is that we have some kind of a financial/economic crash. If we go back to 2008, 2009, and a lot of activity just ceases, then that will kind of put the commodity supercycle on hold for a while. But if we're going to have a world that continues to grow, and I think the central banks of the world will do anything to keep that happening, they'll cut interest rates to negative territory again in a heartbeat, if that's what it takes. So if the world's central banks are able to engineer continued growth from here, then we don't have anything like the kind of copper that we need or uranium that we need and silver. There's a long list of commodities that just don't exist in the quantity that is necessary to, for instance, build out the electrical grid the way it really needs to be built out, and to create all the data centers that the AI guys think they're going to create. Or to electrify the auto market.
The real risk to the commodity supercycle isn't demand collapse. It's policymakers panicking before shortages fully surface. As John Rubino has pointed out, central banks have a long record of choosing liquidity over discipline, and that bias matters here. Global electricity demand is projected to rise more than 3% annually through 2030, while copper supply growth remains structurally constrained. Negative rates, like those used across Europe after 2014, distort capital allocation and delay investment in new mines. Investors should notice that shortages don't disappear in downturns. They compound once stimulus returns. That imbalance reshapes energy, mining equities, and long-duration portfolios in ways most headlines miss. What he flags next reframes why a temporary crash may actually intensify this cycle later.
All of those things require, they need a lot of silver and copper, and the power generation that's required needs a lot of uranium. So those things have great stories that ought to result in way higher prices and really nice arcs for the best miners in those spaces. But it goes beyond that. I mean, rare earths and all kinds of critical minerals. And, if you're an expert on those things, you're positioned really well to create a portfolio that just rocks in the next few years. And, I unfortunately don't really know the dynamics of most of the lesser critical materials and things. I get silver, I get gold, and to an extent I get copper. But the people who have a really broad-based understanding of the commodity sector are worth their weight in gold right now, because so many of these things are just, random words to people, molybdenum, whatever, But if you understand those markets, then you can pick some winners in the mining sector and the processing sector of those markets. And, I think they're still very cheap relative to where they're headed if the commodity supercycle play out. So, I think that's an investment thesis that isn't simple, but if you have the understanding, you should definitely be looking at building a big portfolio of commodities right now.
The quiet truth is that most investors talk commodities without understanding where pricing power actually lives. As John Rubino has warned, the bottleneck isn't demand, it's processing, permitting, and geopolitical control of supply chains. China refines over 60% of global rare earths, while Western miners face decade-long approval cycles. That mismatch explains why many miners remain cheap, despite bullish narratives. Wall Street prefers simple stories, but returns often come from complexity others ignore. For investors, this means selective exposure beats broad ETFs, especially in under-followed processors and developers. What he explains next challenges the idea that cheap always means undervalued in commodity markets.
Yeah, you said they're cheap, some more than the others. Let's say oil and coal. Hated commodities, good contrarian plays, and they're even cheaper than the other ones. What's your take on oil? Sorry, that's my final question.
Well, yeah, I think oil is a good thing to own right now. The highest quality oil companies have sold off to an extent, Oxy Petroleum, and Exxon has done better, but it still has a really good dividend yield. So I think that oil is just one of those things that should be on the list of things you own, in part because the best oil companies pay dividends on top of everything else. And in part because of geopolitics. We're always on the edge of war in the Middle East that disrupts the oil supplies. So you should own some things that benefit from that, since we seem to be determined to fight some kind of a war in the energy producing part of the world. And then, dividend yields. So I think that oil and coal, because we really don't have the energy resources that we need in like solar and wind to be able to build out an electrical grid the way we need to.
Oil isn't hated because it's obsolete. It's hated because it's politically inconvenient. As John Rubino notes, energy realism always reasserts itself after idealism collides with physics. Oil still supplies roughly 31% of global energy, and dividends from majors like Exxon cushion volatility in ways growth assets cannot. Geopolitical risk isn't theoretical when Middle East supply disruptions recur every cycle. For portfolios, oil and coal act as insurance against policy failure and grid instability. Ignoring them increases risk, even for investors chasing clean energy narratives. What he highlights next forces investors to rethink which assets actually provide resilience in crises.
So China, which has been very smart about energy, is they're building everything. They're building solar farms and coal-fired plants and gas-fired plants. So I think we will end up back there too, where we definitely stop closing coal-fired power plants, and then we start building new ones because we really have no choice if we're going to meet the demands of the plans that we've put in place. So that benefits the coal miners and the companies that provide technology to coal-burning power plants. And there are a lot of different angles to come at this. And for commodities, it all looks pretty good.
The energy transition narrative breaks down when you compare slogans to actual construction. As John Rubino has emphasized, China's strategy reveals what governments do, when reliability matters more than optics. China approved over 50 gigawatts of new coal capacity in a single recent year, while expanding renewables simultaneously. That dual-track reality exposes the West's vulnerability if it abandons baseload power too fast. For investors, coal and enabling technologies aren't moral statements. They're demand-driven assets. Policy eventually bends to physics, not press releases.